What is the current condition of the economy? Is the market hitting peaks consistently based on only hype or FOMO? Has the stock market already reached such a state that it does not reflect the economic situation of India at all? And is a crash inevitable? And it is the right time to stay out of the market? Let's listen to ace investor Samit Vartak's view on the current economic condition.
One of the factor which is underappreciated in the market is how the cash flows are and how the balance sheet is, right? So when you look at the P multiple, of course, it looks at the highest level that we have seen in history, about 30 times trailing multiple. I'm not talking about Nifty 50, but say the top 500 companies and their median P multiple is around 32 times, which is pretty high. Even in 2008 or any of the last peaks, we haven't gone to those kind of levels. But then if you look at the cash flow, right, the enterprise value to cash flow, one is the debt has gone down. So when you look at, and that has gone down because of the cash flow that the companies have generated. And most of the companies have taken a call that we just want to be debt free. I mean, you'll be surprised how many companies have become debt free in the last 17 months. And that's where when you look at the cash flow multiple, which is enterprise value to cash flow from operations, it's at about 15.8 times, which is below the historical average over the last 20 years, which is about 16 times, right? Now compare this with the 2018 kind of peak. It was at about 25 times, and even in 2008, the peak was about 25 times. So from here to reach that kind of peak, it's still 60% away. So many a times, and at the same time, just look at the balance sheet. The debt to equity ratio today is at 0.16. I mean, 0.16, we have never seen in India's history. And then the third thing I think one has to look at is how do the cash earnings yield compare against the bond yields. So the bond yields today for India, 10-year GSEC is about 6.2%. And when you inverse the enterprise value to cash flow from operations, which gives you the cash yield, it's at about 6.3%, which is higher than the bond yield. Rarely in India's history over the last 20 years have we seen higher cash earning yield than the bond yields. And if you compare this with 2008, the bond yields were at 8% and the cash yield was about 4%, 50% discount. And you look across all peaks, whether it's in 2000, 2011, 2017, the earnings yield used to be at least 30 to 50% below the bond yields. And that also gives you an indication that, relatively, because after all, it's all relative valuation, right? If everything else has become expensive, it has to be considered against that. And relatively speaking, it's not that worrisome in terms of the valuations. But when you look at from a longer term perspective, from a 2 to 3 year perspective, I haven't seen India's wheels, in terms of the government finances, the consumer finances, the corporate finances, as well as the export potential, all in a favorable condition, all at the same time. And this is probably the first time I'm seeing all of that happening. I mean, just consider that, corporate balance sheet with, such low leverage. I've spoken to so many companies who are planning to double their capacity over the next 3 to 4 years. And almost all of them do not want to take any leverage. They are all just relying on their internal approvals, and it's unimaginable how much strength a really strong balance sheet gives you, because you cannot be pressurized by any customer, any vendor, if your balance sheet is strong. And that's where I do not really fear a crash kind of a scenario when the balance sheets are so strong. Look at the government, so government, who would have thought that, India would be collecting taxes, which is beyond the budget for this year, right? I mean, the GST collection as well as the income tax collection is almost at all-time high and well beyond anyone's expectations during COVID COVID times. Also look at the consumer. See, I mean, majority of the population of India, would 95% would be mostly spending on the necessity items. So that kind of consumption doesn't really change much. Buying your toothpaste or most of the necessity items. But if you look at the top, 2-3% population, or max 5% of the population, their salaries have gone up. I was just looking at the June quarter salary levels. On an annualized basis, compared to a year ago, the salaries have gone up by 1.3 lakh crores. I mean, that's a pretty large sum. So salaries have gone across IT. I speak to pharma companies, and they are finding it difficult to get employees. And if they want to get employees, they have to pay 30-40% higher. So that's pretty strong. And government finances are strong. That means that they will probably meet their infra spending of 1.4 trillion, which is higher than what the US has announced. And we speak so much about the US infra spending. So I feel government finance is strong. They should be spending. Consumer is strong with salary increases. Plus, just look at the wealth increase of just in the last 1 year, not even from March lows, the overall market cap of Indian companies have gone up by 100 lakh crores. And that is, 1.35 trillion dollars. And out of that, 30% is probably owned by, the non-promoters or the Indian public through mutual funds or direct investments. So that's 30 lakh crores. I mean, 30 lakh crores is not even the budget of India for the entire year. So, that's the kind of wealth creation, and that will aid consumption. And we all know about, China +1 and that kind of trend. The environmental clearances today is at, almost all-time high. That gives an indication, leading indication that there is big capex boom coming up. There are companies who are wanting to spend. And there are many, many factors which gives me much more confidence today, where out of a crisis, the balance sheet of everyone, government, consumer, corporate, plus foreign exchange reserves are probably in the best conditions.